Alrighty. I'm going to give it a couple more minutes, let some more people start filing in, then we'll go ahead and get started.
Timmy, one of the things that I think is always fun while we're waiting for people to come in, since we have a lot of registrants, is just let everybody type where they're from and what questions that they might have so that we can make sure that we see some of the things they'd like to learn tonight and also where we have people coming from.
That's awesome.
They can type that just in the chat box. And I see a QA that just popped up.
Yep. So we got one from California, RC.
California. Okay.
Getting cool here in Georgia. It makes me wish that I was in California because they always have perfect weather.
Well, it did. We did just start to get cold out here. Sad to say, it's bittersweet. So I think we can go ahead and at least go ahead and get started with some introductions.
Yep, I think so.
Welcome to our webinar tonight. This is the Introduction to Financial Analysis. We're going to try our very best not to bore you or put you to sleep. However, I know that this is, can sometimes be the challenging part of real estate investing and understanding what a deal looks like and how to analyze that deal, but it's also the rewarding part. If you really understand the numbers, it makes it a lot easier for you to select the right deal. And let's go ahead and go into, let's go to the next slide. We're going to do some introductions. All right, so a little bit about the presenters tonight. I'm going to introduce Jared and myself, and Timmy's going to be presenting with us as well. Jared Garfield is founder of ROI Turnkey Properties and one of the top real estate, investor. He's a real estate investor, a real estate coach, and a real estate trainer. Been for several years, had a radio show. It was a Fox News radio show for 3 years, and analyzed and really underwritten and purchased, invested in properties, a few thousand properties really in about 6 different states. Jared's got a lot of experience, been doing it for a long time, a good personal friend of mine, and he and I have known each other for really a long time, really getting close to 20 years now. So Jared used to be a real estate coach also for Robert Kiyosaki, coaching investors all over the globe. So as you can see, he's done a lot, worked with Flip This House, Flipping Vegas, and has his own podcast and coaching platform underneath Wealth Watch. So we're going to hear a lot from him tonight, get a lot of nuggets and good information from there. And also, next slide, please. And also a little bit about myself. I've been in real estate, I guess, 3rd generation, grew up in real estate. Everyone in my family either developed subdivisions, built homes, or built apartments. And I guess about 18 years ago, I kind of went off focusing on my own real estate, did over 1,000 single family transactions, selling and working primarily with institutional investors, managing as well some assets in another fund where we manage in multiple markets, and had a very rewarding career thus far. Most of what we're doing right now is land development, home building, build to rent subdivisions, and we're doing some value add apartment acquisitions in the Southeast, and that's a little bit about my background.
Adam's being very modest. I think one of the things I love about Adam is, he is always learning. He's always studying motivational books and doing everything he can for self-improvement. He didn't put on his bio that he used to be a top-ranked MMA fighter and did submission fighting. He carved ice sculptures with chainsaws that I saw him do for his wife at his wedding. He is always off with his family, with his kids, doing all kinds of great activities. Recently, they've been doing a lot of kayaking and stuff like that. He's bought kayaks for all of his kids. He has 7 children, and right, Adam?
Yeah, you got those.
You're not at number 8 yet, are you?
That is true. No, I think we're
Right.
done though.
So seven children, but he also, in his quest for learning knowledge and getting better all the time, he recently got a CCIM designation. And most people don't realize that the CCIM designation is one of the hardest, most difficult real estate designations to get. It's a certified commercial investment member. And so that means that Adam's an expert when it comes to apartment complexes and analyzing commercial real estate and different things like that. And so really, I think that we're very likely to have him. I'll probably let him do most of the talking tonight, because when it comes to analyzing numbers and crunching numbers and deciding whether a deal is a great deal or not, Adam's excellent at analyzing the numbers. And that's why so many major hedge funds and Wall Street funds have relied upon him.
Thank you, Jared. Thank you. I appreciate it. Appreciate the compliments. Also, we're going to have Timmy do some speaking tonight. He's going to talk and share with you guys some of the things that he does as an analyst working with our company. He does a lot of underwriting for us, does a lot of analyst work for us. He helps us with the single family fund that we're managing as well. So he does some portfolio management. And so he's going to talk a little bit about how he does some underwriting. We've got a really great lineup for you as far as information we're going to give you. We're going to dive deep into some of the basic financial metrics that you're going to look at when you're underwriting a property. We're going to do a bit overview of common terms. We're going to talk about ROI and return on investment in different calculations. We're going to talk about how to pull comps and what are comparable sales and how do we use them. And then we're going to show how we use our software on a day-to-day basis to underwrite deals. And hopefully we'll have some time if you guys have some deals that you'd like to share with us, and we can analyze. We'll be glad to analyze them for you. If you got some numbers we want to discuss, hopefully we'll have enough time to do all of that as well. And so let's go ahead and dive right into it, Timmy. Okay, so this is the breakdown. This is what we're going to talk about tonight. We're going to talk about cap rate, which is a capitalization rate. And a cap rate is the ratio between the net operating income and basically what an asset costs. So there's different ways to value real estate. In appraisers, you learn when you go to appraisal school is that you can value it based upon replacement cost, what it costs to rebuild that piece of real estate. You can value it based upon a sales comp approach. What does real estate assets like that typically sell for in this market? And you can also value it by income. And so anytime you value a property by income, because the property's leased up, and when you value it by income, they typically use what's called a cap rate. So all across the country, there are companies that will generate cap rates for different commercial assets. And they'll say, okay, in this city, cap rates for industrial or office or multifamily are, X. And as cap rates change, so it's basically, for those of you that are buying and selling on sales comps, that's what a cap rate is for an income property. What are the cap rates in the area for properties like that? And so we're comparing cap rates now instead of comparing sold properties. And that's the purpose of that. And a cap rate is really, it's your net annual return on that first year, if you're paying cash for the property. So if you're going to buy a property, pay cash for it, and you take out your operating expenses, whatever your NOI is, your net operating income for that first year, that's what you use for the cap rate. And again, it's on a cash purchase. We're also going to talk about cash on cash returns. Cash on cash return is exciting because that's a leveraged return. Okay, and when you get into leveraged return, there's three different types of leverage. There's positive, negative, and then there's just a neutral, basically, which is even. And that would be something like, for example, if you're getting a 6% cap rate on a property, and that same property you're borrowing money to purchase it, and you're paying a 6% interest. That's neutral leverage. And in another situation is if you're getting a 7 or 8% cap rate, and you're paying 4.5% interest. Now you've got positive leverage. So not only, if you're putting 25% down, not only are you getting that 7 or 8% cash flow on your 25%, but you're getting the spread between a 4.5% interest rate and a 7 or 8% cap rate on the entire amount without even having any money involved. So, right, it's kind of like arbitrage. That's what leverage is for. Basically, that's how leverage helps us in real estate. And we're going to talk about it, and that's positive leverage. There are situations, I know a lot of you are from California. In the past, it's happened several times in California where you have negative leverage. In other words, because there's no cash flow. Typically, in other words, you're paying your cap rate maybe like 3 or 4%, and you're paying 6% interest. It's negative leverage. And oftentimes it's worked out successfully still in areas like California, or areas where the appreciation was so high, it didn't really matter that you were getting negative leverage. Okay, we're also going to talk about comps. And when we say comps, those are comparables. And when you're looking at rental property, you're looking at comparable rents and you're looking at comparable sales for similar properties. There's another term that I want to make sure that we're all familiar with, which is ARV. This is an after repair value. And we use this often when buying a property, when we know, okay, after I fix this property up, what is it going to be worth? So we're not looking for comps that are just, if we're buying a distressed property, we're not going to look for comps that are distressed or in that similar condition. We're going to see what the potential is of this property. So we're going to look for comps that have already been renovated and that are in really, good marketable condition. And that's what we're going to compare a property to. So we're not trying to find the current market value. That's not what we're doing. As flippers, we're looking for the after repair value. The next term is NOI, net operating income. This is really important. In real estate, often, even in commercial real estate, sometimes you hear things that are above the line and below the line. And what that means is, what expenses are we going to take out of our cash flow to generate our net operating income? We're going to talk about that a little bit. Now, net cash flow is we're going to take out expenses, additional expenses that are below the line, things like a mortgage. If it's leverage, you're paying a mortgage, we're going to take mortgage, or, you can even also take taxes or things like that out of your cash flow to create your net cash flow. Okay, next slide, please. Now let's get into the fun part, the calculations. How do I calculate a cap rate? It's really simple if you have your NOI, which is your net operating income. And the way to calculate your NOI is to take your gross rent. So if property's renting for $1,000 a month, that's $12,000 a year. And let's say if your expenses are $3,000, then your NOI is $9,000. Real simple. Take your net operating income, divide it by your all-in cost, divide it into your all-in cost, and that's going to give you your cap rate as a percentage. Your net ROI, is your current value of your investment over your total cost divided by your cost of investment. Okay, you don't have to understand what this means now. I'm just giving you a brief overview. We're actually going to go into it on the other slides. Cash on cash return is your annual cash flow divided by your initial cash investment, which is basically how much you spent out of your pocket. Now, if you're paying cash for a property, then your cap rate, you have to understand this, your cap rate and your cash on cash return will be exactly the same. Okay, so if the cap rate's 6 and you're paying cash, you're not using leverage, the cash on cash is also going to be 6%. The only time that number changes is when you introduce leverage. And whether it be positive, neutral, or negative leverage, that's how the cash on cash either goes up higher or lower than the cap rate. Okay, so that's the part I think one of the things that's going to be most important for you guys to understand tonight is how to calculate a cap rate and how to calculate your cash on cash and understand the relationship of how that works. Okay, remember it's the exact same number unless you introduce leverage. All-in cost to ARV, that's kind of a simple mental calculation you can do on going into a property. If you don't have time to put a pro forma together and run a bunch of numbers, you're just going to have to figure out, you can take the total amount that you're invested over the after repair value of the property. You're basically trying to figure out, you're ultimately trying to get how many cents on the dollar am I paying for this property? That's what you're trying to calculate. And a lot of times we'll show you where you need to be there, because once you go to get lending, you'll find out lending, they say they'll give you sometimes 80, 85, or in some cases 100% loan to loan to cost as long as you're at a percentage loan to value. So it's that percentage of loan to value that you really want to understand. And if I'm going too fast and throwing a bunch of stuff at you, don't worry, we're going to go into it in greater detail. This is just me giving you an overview. Next slide, please. Now, so let's talk about cap rate. This is called capitalization rate. They call it cap rate for short, or you can call it cap. So for example, here's a example property in Beaufort, Georgia. It costs $125,000. The monthly rent's $1,200. So let's look at some expenses that we can take out of the monthly rent to come up with our net operating income. So we've got $1,500 a year in taxes. Property management at 8%, we're looking at $1,152. Maintenance and vacancy, we've got about the same. We've got insurance at $600. If a lot of you guys thinking that's cheap for insurance, then you probably need to be looking at, if you've got a portfolio, you can get a portfolio or kind of a blanket or commercial policy that'll be a lot cheaper. I know some people pay twice that. We only pay twice that when we're buying in Florida. So in this particular case, net operating income is $9,708. So here's how we came up with that. We took $1,200 a month times 12 months, and that gave us $14,400. And then we took the $14,400 and we subtracted $4,692. And $4,692 is basically the sum total of your taxes, property management, maintenance, vacancy, and insurance. So we took all of our expenses out. There's our net operating income. Now we're going to take that net operating income in our calculator. We're going to punch in the income first, and then we're going to hit divided by 125,000. So 9,708 divided by $125,000. And that's going to give us our cap rate. Real simple. And we just make sure it's converted into a percentage, because you're going to end up with like 0.078 with some numbers after that. And so you just move the decimal point 2 times, and that'll convert it into a percentage. You move it to the right 2 times, and that converts it from that decimal point over to the percentage. Okay. So we're going to try to make this as interactive as we can, because I know this can be a challenging topic to talk about. So at any point in time, if you have any questions, and Timmy, you help me keep an eye on the questions. And
yep, got it.
Thank you. You help me keep an eye on the questions. So if you guys have any questions about this while we're going through it, please feel free to mention it. So 9,700 divided into 125,000 gives us 7.8%. Timmy, next slide. Cash on cash return. Now, remember that what I told you here, that this is, if you're not using leverage, your cash on cash return is going to be the same thing as your cap rate, because you're putting out the same amount of money into the property and you're taking the same amount of money out of the property. So the only difference we're going to show you here is we're going to show you what happens when you add a mortgage and create leverage on this property. So now we're going to go out and we're going to get a loan, and the terms of that loan, we're going to have to put 25% down, and our interest rate's looking really good right now. And I don't know if a lot of you guys know this, but we've got a 4.5% interest rate, because I've been told that you can get a 4.5% interest rate on an investment property today. I just think that's just outstanding. So we're going to take the down payment, which is 25% of $125,000. That gives us $31,250. Now we're going to take the monthly rent times 12. That gives us our $14,400. Now, what expenses do we deduct from this cash flow? We're going to go back and we're going to deduct the same expenses we did in the last slide: taxes, insurance, property management, vacancy, and maintenance. But this time we're also going to include our mortgage payment. Our annual mortgage payment on this property is $5,700. So we take that $5,700 plus the expenses we have laid out here, and the total, we've got $10,000. Exactly $10,392. So we're going to subtract that out of our $14,000. That drops our cash flow all the way down to $4,000 a year. Now our net cash flow is $4,000 a year. That's your cash flow after all your expenses and after your debt service, which is your mortgage payment. Now, even though our cash flow is reduced, what is also reduced? The amount of money we're actually bringing to the table and putting into this property. Instead of bringing 100% of the 125, we're only bringing 25%. So technically, so you take that, we're only out of a $31,000. So you take that $4,000 and divide it into $31,250, and that gives you a cash on cash return or a leveraged net return of 12.8%. That's a great, fantastic return. Do you see the difference with leverage? We went from getting, what was our cap rate, Timmy? Back up a little bit. We went from getting a 7.8% return on our money to a 12. Go back, Timmy, was it 12.8?
Yeah.
Went from 7.8 to 12.8 just because we introduced leverage. And now we can take our money and invest it in more properties to get this type of leverage return.
Adam, I'd point out that doesn't even count tax advantages. Tax advantages are going to be another significant savings, and this doesn't even take any of that into account yet.
That's right, Jared. And we're going to talk about that a little bit. We've got a surprise at the end. We're going to talk about total return, which we'll get a chance to discuss that a little bit as well. Go to the next slide, Timmy. All right, so net ROI. Now we're going to switch gears. Instead of thinking about income properties and calculating our cash flow from income, we're going to think about flipping a little bit. Right now we're going to look at our net ROI, which is basically our net return. We're going to go back to our purchase price of this property. And the one thing you didn't see earlier is there was a purchase price plus a renovation cost. That's how we got to that $125,000. So if you take $100,000 plus 25, now we're $125,000 cost. Oh, sorry, we did get a question. Did we include closing costs? We did not include closing costs in these calculations. And this is this purpose of this is really just to show you how to do the math. So, but when you're calculating your out-of-pocket costs, closing costs, or points for your mortgage, which are not in this calculation, you'll also add that in there. Okay. So 100,000 plus 25, now we're at 125. We've checked around, we've pulled comps. We felt like that if after we've renovated and put this property into good shape, put it back on the market, we think the after repair value will go about $180,000. Okay, and so now thinking about this, because I'm going to flip this property, I got to think about when I go to sell it, I'm going to pay a real estate commission, and I put 6% for a real estate commission, which is $10,800. In this scenario, I have added closing costs. I've added $2,000 in closing costs. That was not closing costs on we're going in to buy the property. This is on the exit. So that just increases my cost. So I took my $125,000 plus sales commission plus closing costs. My total cost is $137,800. Okay. You can add closing costs going into it. That'll bump it up a little bit as well. So if you take $180,000 minus the cost of renovating it and flipping it and purchasing the property, and that's going to give you a spread. Okay, that's going to give you what's called a margin or a profit amount. And the margin is the difference between what you owe or what you're spending, the total cost of the property, and what the property's worth, the actual value. And that's your margin or your spread. And so you take that margin, divide it by the total purchase price of the property, which is $125. That gives you a net ROI of 33%. So your return, if you can do all this within 6 months, you're going to make a 33% return. Now you can, if you want to divide it, take 125, divide it by 125,000. Ultimately, what you're trying to figure out is how much room do I have in here? And I'm going to show you another when we get into discount to or ARV. I'm going to show you another little, probably a little faster metric that you can use in your head when you're doing your acquisitions. This is what an ROI. It's basically if I buy this property, I'm all in, and at my all in cost, what's the difference between my all in and that value? If I was to go ahead and sell it or flip the property, how much return am I going to get? What's the return on my investment? And so there are a few additional items that you can add into this calculation, but ultimately this is how the calculation is done. You take your margin or your spread and divide it into your all-in cost. Next slide, please. Okay, all-in cost to ARV. And this one I like this one a lot because it's quick and easy. So it just gives you kind of a guide or a benchmark. Okay, so your purchase price is $100,000, repair cost of $25,000. After repair value, again, all the numbers are the same, $180,000. All I'm going to do is I'm going to take $125,000, which is what I'm paying for it, divided into $180,000. And it's going to give me 69.4%. So I'm paying 69% of the total value of this property. And what that means is I'm paying 69 cents on the dollar for this property. Okay, that means I'm getting a deal. And even though I'm renovating, when you renovate and you add value, you're creating that equity. So ideally, you want to be less than 75%. So in previous markets, when it wasn't as much a seller's market, investors were trying to be at 70 cents on the dollar. And this is the value part, right? This is where lenders say, well, we're only going to lend you up to 75%. And I think today it's pretty common, 75% loan to value. They say, we'll give you 80, 85% loan to cost, but we're only going to give you 75% loan to value. So whatever the lower of that amount is what we're going to lend you. So whichever one of those numbers are lower, right? And so today's you want to be at 75 cents or less. It's really difficult today. I think it's a seller's market in most markets. The housing market's crazy. And ultimately to get a deal, you're really trying to find homes that have deep distress, or you're building a house from scratch, creating kind of maximum value add on the property. So in some markets, you may only be able to get 85 cents on the dollar because they're moving so fast, right?
I think one thing that's really important here, part of the reason that our inventory in Huntsville has slowed quite a bit is we can't buy stuff at 70 or even 75%. A lot of times you're having to buy at 80% of after repair value if you're in the Huntsville market, because it's just so hot. There's so many owner occupants that are competing for the same inventory. And then you get investors that are going to do the work themselves, and they're just going to keep the property, and they're speculating and basing on appreciation, wanting to buy the asset. Or maybe they're willing to be a slumlord, and they just do lipstick on a pig, and they don't really rehab it very much so they can get by with it a little bit. But these are very important numbers, because if you're trying to buy yourself and do the rehab yourself, by the time you take into account the holding cost and the closing cost and the points that you might pay your lender, and then you might have commissions when you go to resell it if you're flipping, it gets very difficult to be profitable. And we found in Huntsville that we would often, towards the end of the cycle, when it was getting into an expansion cycle and being really red hot, where we had gotten in during decline and absorption, we found that we were doing all of this work and taking a 3-month cycle, putting up, $90,000 to $100,000 of capital invested into a property to make $5,000. And it's like, why would you do that and go to that risk and go to that effort when you could just go sell a $300,000 house to a retail buyer and make $9,000 with none of the risk? And so these ratios are very important when you're looking to buy properties. And Bob asked the question, aren't there people who are accepting, lower ratios right now because it's such a seller's market? And that's true. But in my opinion, those are the investors that are not really sophisticated.
The smaller the spread that you're looking at, the more risk that you take of something happening and something not working out. And if you can't get the spread, then you might as well buy something turnkey. Because if you can't get the spread on the value, then maybe you should consider not taking that risk, buying something that's already been renovated. Ultimately, when we're buying, people ask, "Oh, do you buy foreclosures?" And we don't really care what the status is. It doesn't matter where it came from or what's the status. The numbers either work or they don't. And then oftentimes properties that have been neglected or properties don't sell because they need a renovation, yeah, they make better targets for investors, but ultimately you got to make these numbers work. And so many investors will go into a property thinking, oh, this is a great deal, I can do this work. And they'll do some calculations in their head on the front end, but they miss a lot of the nitty gritty. They say the devil's in the details. Somebody made a comment about closing costs. So we add that in there. if you don't add closing costs and all those expenses pertaining to that specific property and give yourself a buffer, some time, carrying costs, things like that, there's a lot of little details you add in there. I think RC had asked on the first slide, why don't we have closing costs and down payment are not included? Well, closing costs should be included. So for example, go back to the first slide, Timmy. I want to answer this question real quick, cap rate. So your closing costs, all you're going to do is add it to your 125,000. So you're going to take, instead of dividing the 9708 by 125, you'll divide it by 125 plus your closing costs. The reason that your down payment's not in here is because debt leverage, you don't include leverage when you're calculating cap rate. More debt service is what we call, is called below the line. That means you don't include it in your operating. Debt service is not included in your operating expenses when you're calculating cap rate. It's only included when you're calculating cash on cash return.
Adam, one of the things I'd recommend to investors today that I didn't recommend 2, 3, 4 years ago, typically when you're buying from turnkey providers, the margins are thin. Companies like Real Wealth Network have negotiated really good pricing for their clients. I would recommend possibly increasing the price of the property and asking the seller to pay your closing cost. That way you're not really asking for a concession, but in today's hot market, when appraisals are going fairly well, that can be a better way to improve your investment by increasing the price and having less cash out of pocket invested into the property.
That's a good point, Jared. Very good strategy. Thanks for mentioning that. Tim, you want to bring us back current on our slide? So this is, again, quick ratio. What are we paying for the property? It's just a quick guide to help you know, am I overpaying for the property or not? Is there a margin in there? Next slide, please. So total return, this is probably one of my favorites. So sometimes people tell me, say, well, I'm invested in the market. Why do I want to invest in real estate? Well, a total return is how you compare apples to apples when you're looking at the differences between investing in real estate versus investing in something that's not real estate, like stocks, bonds, commodities, anything else, right? Because so now we're going to take in the total, all the different advantages we're going to get from real estate investing, okay, that you may not get from other asset classes. Some of the other asset classes have part of these, but not all of them. Okay, so let's go through this a little bit. So we're going to look at 4 different areas. Our annual cash flow. This is our cash flow after our expenses, after our debt service. We're left with that $4,000 a year cash flow. So if we take that $4,000 and we also look at principal pay down, it's $1,327. Let me tell you how we came up with that number. We took the down payment. So we put $31,000 down and on a $125,000 purchase. That's $100,000 for the house, $25,000 renovation. Our lender did say we could finance the renovation costs, but we put 25% down. Now, at the end of the year, in a year from now, most of my payment that I'm making, that $5,700, is going toward the to the lenders, going toward interest because of the way an amortization schedule works, right? You pay mostly interest up front, little bit of principal. Well, this represents, that $1,300 represents that little bit of principal we're paying. And honestly, $100 a month is actually a lot because interest rates are so low. Look at how much principal you're paying because interest rates are so low. And I do recommend, if you're going to do real estate investing, get a financial calculator and learn how to calculate mortgage payments, future value, stuff like that. It will pay off in the long run. Now, the third thing we're going to look at, tax benefits of depreciation. Did you know you can depreciate your property off of your taxes? And so what we did, the way we calculated this is we took the improved value of the property, which is the total value minus the land. We took the approved value and then we depreciated it. Now, first of all, I'm not a CPA. I'm not an attorney or tax attorney. So consult your CPA. These numbers are for illustration purposes only. So talk to your tax advisor and figure out how much can I depreciate off of this property in a year from now. And with the calculation we use, with 3.636%, and we multiplied that by 33% tax bracket, or what you can multiply by whatever tax bracket you're on. And we took that depreciation by the tax bracket. I saved $1,100 on my taxes, basically, for depreciating, or the $1,100 on the cash flow for depreciating this property. Now, the second thing, and you can tell this one right now today is pretty powerful. From appreciation in a year, we got $5,400. Now, a lot of markets today are appreciating pretty significantly. All we did for this particular example property, we put on there 3%. Pretty much every market we're in appreciated much more than 3% over the last 12 months, even with COVID and everything. However, this one we just put at 3%, $5,400. Now I'm going to add these up. I'm going to take the total of the 4,000 plus 13 plus 11 plus 54. That gives me a total cash flow at the end of the first year of $11,800. Now I divide that into our entire out-of-pocket cost. I think it was $31,250. Plus we can add some closing costs going in on there. And that gives us an IRR, which is called internal rate of return, or it gives us a total, what we call total return of 38%. So if your stocks or bonds or investment did not give you 38% return in the course of a year, is it better or worse? Well, just keep one thing in mind: real estate is not passive. You're earning this higher return that you're getting because you have to manage either real estate, or you have to manage a property manager, or you have to manage a process of moving parts. You don't have to do that in stocks and bonds and or anything that's passive. Some of them you do. Actually, if it's a mutual fund with a money manager, professional money manager, you don't. But often if you're buying stocks and bonds stuff, sometimes you do have to work with that stuff. So ultimately, a 38% total return. So what we found out that this particular property that we purchased, this example property, it'll have a cap rate of 7.8%, also has a cash on cash or leverage return of 12.8%, has a total return of 38%. That is the magic of real estate investing. And that's how you speed up your retirement when it's done properly. And that's something you can't get in a lot of other areas and a lot of other investments. So I hope you guys really kind of understand how the math works and how we analyze these different properties. So next slide. So
We actually got another question here, Adam.
Okay.
How does the idea of cash flow and equity play out once it comes to the sale of the property? Isn't there going to be an equivalent tax impact?
No, there's not. You're talking about a recapture. This is the part you're going to love. Another part that I love about investing in real estate, right? So capital gains taxes, again, I'm not a CPA, but look, capital gains taxes are around 21%? And the cost recapture are in the low to mid 20s as well, the recapture tax. So what happens is over time, they're going to let you depreciate. So we do this in apartments, and apartment investors do this all the time because you can depreciate the heck out of an apartment building over the number of years. So they'll depreciate it over several years. Now, when you go to sell it, there's a recapture tax. They're saying, hey, all this money that you took off of your income and didn't have to pay income taxes on, you're selling it now. We need to recapture some of those taxes. But the tax rate is lower than the income tax bracket. So the recapture tax is less. It's like low to mid 20s, whereas your typical income tax is higher than that. So it could be like maybe 25% as opposed to paying 30 or 33 or whatever the current tax bracket is. And I don't know about you guys, but taxes have a tendency to keep going up in the future. So you do have to pay some taxes, not along the way, but toward the end when you sell and you're making that big lump sum, but it's less than what you would have paid in income taxes. And that money kind of grew, and so you didn't have to pay it out of your income. You got to keep the income along the way and use that, and it's using that cash makes a big difference. So I'm glad you asked that question because that's another one that sometimes people miss. Okay, so Timmy's going to dive into showing us how to pull some comps, and we'll show us how to analyze the property. So let me give you a few highlights. And Jared, you're welcome to talk, kind of jump in here as well. I know Jared's you know, a big part of what you do is managing comps and sales comps. But when you're looking at comps, there's some guidelines, okay? So this one has no more than 300 square foot difference in the property. Ultimately, it doesn't have to be exactly specific number higher or lower square footage. It just needs to be similar. If you've ever lived in a house before, you know the difference between living in a 1,500 square foot house and a 3,000 square foot house, okay? They're going to be completely different. So you try to get as close as you can. You're looking for similar or comparable property. Same number of bedrooms. This is probably one of your big ones, right? A 3-bedroom house and a 4-bedroom house are just going to be sell differently. They're just going to be priced out differently. So you want to find something with the same bedroom count, sold in the last 12 months, ideally 6 months, be within 5 years age difference. Sometimes it's tough to do that, but again, get as close as you can. If a property is super old and you've got one that's brand new, they're not going to compare really well together. You want to be in the same neighborhood or no more than 1 mile apart. I know appraisers, in most cases, they go up to 2 miles apart, 2 miles away from the subject, but ultimately, same neighborhood's the best way to do it. If you can't get that, understand. Let's go to the next slide, Timmy.
Before you move to the next slide,
Okay,
one of the things I would point out on some of these things, obviously, like on the first one, if the house is 400 square feet bigger, they may still use it. They're just going to take a certain dollar per square foot cost, and they'll say, well, your comp is superior, and they'll subtract from your price if the comp is superior. So if the comp is superior, they subtract from your price. If the comp is inferior, they add to your price. And when you look at the same number of bedrooms, that's important. But if there's a 3-2 house that's 2,000 square feet, and yours is a 4-2, and your rooms you have one less room, but your rooms are much, much bigger, that won't have quite as much of effect, but it does have some effect because sometimes your rent would be a little bit less, even if the square footage was the same. Another thing that I would point out is that typically, if it's within, let's say it's 10 years older or 15 years older, it's a bigger deal as you come to newer houses than it is if it's older. So if I'm looking at a house that's 2020, and we're looking at a 2010 house, even though that's 10 years, that's not necessarily, that's a little bit of a big deal, but it's less big deal when you go back and you're looking at, say, a 1970 house and a 1960 house. Those are going to be fairly similar, and that won't make as big of a difference. And they also have in the appraisal the effective age. So if a house is 20 years older, but everything's been completely renovated with new kitchens and new bathrooms, they will go off of the effective age as well. So there is some latitude on some of these, but you want to get as close as you possibly can. And I would also say building style is an important one that's not on here. And that would be, for instance, you want to compare ranches that are all one level to other ranches, not ranches to split levels, because basement square footage or below grade square footage is not worth as much as first floor square footage, and second floor or attic space square footage that's been finished attic into living space, that's not as valuable either. So keep those things in mind.
Thanks, Jared. Those are really good points. Really good points. And so let's do this. We're going to dive in and we're going to show you. And what we're going to show you are 2 steps. We're going to do comps first, Timmy.
Yep.
And we're going to show you selecting comps, and then we're going to show you adjusting comps, which is what Jared was talking about. First, you select your comps that are most like your property. Then you make adjustments for the areas where it's not like your property. And that's what we're going to talk about. There's a lot of different tools that you can do this with. We're going to grab, this is just a tool we use a lot, and a lot of realtors have this. It's called RPR. It's a free tool if you're a realtor. So Timmy, go ahead and you take it away.
Okay, yep. Just like Adam mentioned, this is RPR. So we're going to go a little bit of the old school way of how we used to pull comps really before house folios. So let me just type in this address here real quick. We're going to go ahead and take a look at it. Ohio. And here's the kind of the summary of RPR that we get to see. You get your little street view here from Google Street, some of the different home facts and such as you scroll down. And then we'll go up here and we'll start creating our comps here. So the first step is you really confirm all your facts. So this is a 3-1 with 1,009 square feet. And we'll come down here, move all these. So we want to show all of the different property statuses, especially the sold and under contract ones we want to make sure we have. And like we mentioned on the previous slide, we want to do ideally within the last 6 months, but for this, I'm going to go the last 12 months. And I will do that, and we'll go ahead and search our different comps. So you can see here as well as like the Google map, this is all the different comps that show up all around our property. And we can go ahead and scroll down and start selecting our different comps. So right here, this is a 3-1 that sold for $73,000, and you could, if you saw real quick, right now RPR was saying was pulling the value at $66,000. So
now, Timmy, it's good to mention that there's a lot of comps on here. Most of the time, you're not going to see this.
Yeah.
You're looking in areas that, this is in, I think it was in Cleveland, there's areas where you have a lot of stress. And what he's looking for, how does he know which one to select? He's going to try to find the ones that are not distressed, or he's going to find properties that are post-renovation. And he can do, those are typically the ones that are most expensive. So he's going to look right around his area, as close as he can to his property, in the same neighborhood, and he's going to find the most expensive comps. And when he starts looking at the pictures of those comps, you'll see that they've been renovated, and that's why they're more expensive.
So I'll go ahead and select these because they are just about within the 300 square foot range.
Typically, Jared, how many comps do you like to pull in your properties?
Adam, it depends on how confident I am in the comps that I pulled. So if I have a house that has pretty much the same floor plan and a similar elevation, but maybe the garage is on the opposite side and it's the same exact square footage built by the same builder within 2 years of when mine was built, if I have 2 of those comps, I might be fine with 2. But generally, I like to have 4 to 6 that are within 6 months. Maybe I'll even go to 7 or 8 or 9 months. If comps are hard to find, but typically 3 to 6 is typically what I want.
Thanks, Jared. It's great. It's perfect. Go ahead, Timmy.
So we'll go ahead and take a look at our selected comps now. So now I'll scroll back up now that I got 2, 5 selected. Update our evaluation. And you can see right here our range. The lowest square footage price on a house that's sold, if our house sold for that exact same square footage price, you see here that it would sell for $58,738, and if it sold for the highest dollar, it'd be $109,334. So we can go ahead and adjust our comps here.
All right, so now you've selected properties, and one thing that we didn't go through, which we'll often do, is we'll look at the photos of the comps to see when it was sold, see what kind of conditions it was if we can. But Timmy selected comps. Now he's going to show you how to make adjustments to those comps.
Yep. So just for this example, let's say the $73,000 one compared to the couple $100,000 ones that we selected was not up to the same rehab standard as those ones after looking at the pictures and such. So we can say this one is actually worse than ours. And you can see it'll start adjusting it right away. And that'll bump up the ARV of our own home. And let's say we think it's actually even worse than that. You can see it continuously just keeps bumping up our average and what our ARV really is. And let's scroll here. Let's say this one has a little bit over that 300 square feet. So, and we take a look at the pictures and say, okay, this one's a little bit higher of a rehab standard. So we can go ahead and make this one a little bit better. And you can see it once again, adjust it. It lowers our ARV actually when you do that. Yeah. And as you scroll down, you can just keep seeing all the different facts of the house, like the living area, square footage, does it have a garage, the year built. And now you see these are really old homes up in Cleveland, where I'm actually from. Back in like our home that we're actually looking at was built in 1915.
Now, and it's important to remember that you're going to do this one property at a time. So if you only had one comp to go by, you're going to look at that comp and say, is this comp better than my house? Or is this comp worse than my house? And so, for example, if all you have is the property that's $123,000, like that first one, and you say, well, my house is actually going to be better than this after I've done my renovation, then right there, you know that your house is worth more than $123,000. And the same thing. And then you go select the next house and say, well, this tells me my house is worth, more than 105. And then you start comparing, right? Or so what you might find in here is that the 123 is superior, and you're going to say, well, it's worth less than 123, but I know it's worth more than 105. It's definitely worth more than 100. So you're going to do one house at a time to help come up with an adjustment or comparison for your house.
Yeah, that's just because this is just your average of everything that you've selected. So you really,
and you're not going to look. You're not appraising the house, so you're not even going to need to go this technical. And what Timmy's doing right here, we just wanted to show you this because it illustrates the concept of making adjustments based upon any kind of slight differences with your subject property and with the comparable property. So if anyone has any questions, we'll be glad to answer questions on this. Timmy, go ahead and save what you got. And then ultimately what Timmy's going to come up with is a range. I think the house on the low side's worth this, on the high side's worth that. And you're basically just going to come up with a feel after you make those adjustments. I don't want to spend too much time on that. It's not an appraisal course. This is just giving you the concept of selecting your comps, making adjustments to those comps, and coming up with a range of what you think the property would sell for, the ARV. Now, let's jump back, Timmy. Let's take them into house folios and let's show them how it plays in. Now, I've pulled comps for the sale. Now, that's the same way you pull comps on the cash flow, on the rents. Okay, now rents are actually a lot easier to pull comps from. There's a lot of data online, a lot of free data online that's fairly accurate when it comes to determining what a property will rent for. But Timmy, I'm going to show you. Timmy's brought us into house folios. This is our software. We got sick of using spreadsheets to analyze single family homes. And so we ultimately, because it was the same thing over and over again, and our spreadsheets were getting too big and breaking, and people didn't know how to, it was hard to train analysts, sometimes too difficult to train on spreadsheets. So we created the software, licensed it for anybody to use. Timmy's going to show you how we use it to analyze our deals.
Yep.
Go ahead.
So this will be our sample property that we're going to dive into first. And you can see house folios is it's connected to local MLS and Zillow and such. So it'll automatically pull in info that is on those websites. And so you can see here some of the different pictures and such of this property that were most likely on Zillow. You can just scroll through a couple. And then you can see here that it pulls the house facts, so how many beds, baths, the square footage, the year was built. And then it even pulls if there's a Zillow description or description on the MLS, it'll pull in that description and it'll also give you the subdivision. And then as we scroll down here, you can see our three different items that we look at for our investors and when we're doing it internally to be able to decide if it's a good house that we should purchase or what our route we should go about it is. So you can see here, it really is a really good buy and hold property. So right now it has a 9.26% cap rate, an 18% cash on cash, and your net monthly cash flow is $430 right now. And you can see here how it's color coded. So the green obviously means it's very good. It's above your targets, and I'll get into the targets in a second here. And then the red obviously means that's below your target. So we have our different calculations here. We have the asking price of $80,000, and so that'll be the purchase price, same as the asking price in this instance. And after looking at those pictures, I just kind of threw in a rough number of like $25,000 for rehab, so that'll automatically count in your numbers up here. And then right now, this has an ARV of 140,000, and I can actually switch over to
Timmy, hit the drop down arrow in your ARV real quick.
Yep.
So if you guys don't know, this pulls data from ePraisal, Zillow, and some other different sources. So it shows you a number of different estimates of value from different sources. And I think you've got the same thing. Do the same thing for your rents. Where are your rents at? Rental income. So again, you've got renovated, you got a whole bunch of a number of different places. So it pulls in some of this data automatically for you. So to kind of help you make some assessments.
And then when you're messing around with your properties to really try to nail down your numbers, we also have the assumptions tab. So you can come down here, and let's say for your insurance for this property, you have a quote, anything like that, and it's actually going to be like 600.
You wanted closing costs. You guys want closing costs. You want any acquisition costs. Everything you can think of, you can drop it in here and as an assumption and apply it across every one of the properties you're underwriting.
Yep. Yeah, so just so like if the insurance isn't 700 for you, it's 600, you can go ahead and change that. If you're actually putting down 30%, you can type in 30% right here, and you can actually see the numbers change in real time, which I will actually do real quick. Just put in 30. And you can see your cash on cash now is at 67%. And I'm gonna go ahead and change that back real quick. So you can just keep playing around with your numbers as well, and just keep looking at your different options up here, like your 3 different options to see which kind of deal it might make sense.
So underwriting, so Timmy, I think what we're illustrating here is underwriting. This is a little bit easier. It's going to do the calculations for you. All you have to do is verify your ARV and verify your rents, and then figure out how much renovation it needs, right? And then once you've verified some information, if you look at it, you got an asking price, your ARV, and ultimately your purchase price, that's how much you're actually paying for it. And if you put a purchase price of less than 80,000, it'll show you what percentage below the actual list price that you're paying for the property. So at 70,000, you're paying 13% less. And so if it's been on the market for a long time, 180 days or more, you can maybe be able to do 20, 30, 40, 20, 30% off of their list price. But if it's only been on the market 2 weeks, good luck. They're not going to take a lot off the price. Tim, you want to show them also how to do some comps while you're in here?
Yep.
You're probably going to do that.
Yep. I'll head over to the comps. So actually, real quick.
Eric has some good ways to pull comps using Zillow as well. And then we can show you how to do that here.
Yep. So real quick, you can see one of our options here was the adjusted comp average for your ARV. And then if you click over to the comps, you can see House Folios will automatically pull in your comps, just like how I showed on really the old-fashioned way now on RPR, was how I had to, I don't want to say painstakingly go through them and select my own comps. House Folios will now go ahead and do that for you. And you can see the same thing here of your range of the different properties with your average as well. And then we have kind of the same feature of RPR here. So let's say we scroll through these pictures and we feel this property is worse than ours. We can go ahead and adjust that, and it'll automatically adjust our average. Let's say if it's actually better, you can see it do the exact same thing there.
This is going to be a little bit easier to use if you're not an appraiser. If you don't want to get too technical, this is probably going to be a little bit easier to come up with a quick value. But ultimately, a number of these comps you're going to find that don't work, so you're going to want to delete some of the ones that don't work in here as well, that aren't applicable. So
you can go ahead and just hit these little dots, delete property, and you can see it adjust the numbers as well from there.
Yeah. So again, you want to try to get down, like Jared said, 4 to 6, 3 to 6 comps. They're the 3 to 6 properties that are the most comparable that are going to do your property justice. Okay. And then once you select those, then you want to make some adjustments to them. Timmy, is there a way also, Jared likes to check, Jared, didn't you say you like to check the sold price, I think on Zillow?
Yeah, sometimes when we pull in House Folios, I don't know how Zillow reports it differently, but I have noticed that sometimes when you go into the comps for this property, so Timmy's has got plenty of comps here, and I love how the map shows the subject property in blue, and it shows how close the comps are. So I would argue that probably comps 2, 3, 4, and 5, and 7, and maybe 1 might be more accurate than comp 6, 9, or 10, because just looking at it, I can see that this Flint River Road, this is a fairly major road. This is not in the same subdivision. So 6, 9, and 10 may be built newer. They may be different styles, but these all seem to be in the same subdivision. So I'm going to trust 2, 3, 4, 5, and 7, the most, and I'd probably go over and look at those first and see how it compared. And you can see that a lot of these are in fairly close proximity. I can see that 4 and 2 look like they're pretty close. It would be interesting to see if 9 and 10 were different. Like this is what I was saying here. Comp number 6, that probably is not going to be as likely. This is a multi-level home. You're going to go in. You're going to go downstairs to a lower terrace level that's partially underground. This comp, I wouldn't necessarily delete it all automatically because it's similar age and things like that, similar construction quality, but that's not as good of a comp as some of these ranches that we have. But at 9 and 10, you can see again, they are different. I said right off the top of my head, just looking at the map, that I thought 9 and 10 would be the least accurate comps. It's a different builder. They're multi-level. They're both multi-level homes. It looks like they're maybe a good bit bigger. Sometimes on multi-level homes, you have to be careful because this 1,248 square feet on comp 9, that house is probably bigger than that. They may very well not be counting square footage in the lower level. I would bet that this lower level is not counted, in the square footage there on the tax records, and that may be true for this one here on Westbourne Drive as well. So we were right there. So just looking at the map and noticing that, that's the first thing I would do is I'd go to the map and I would try and analyze the comps that were closest to the subject property, and I'd click on those first. And usually when you click on them in Zillow, you can actually go and click in and see the sale dates. And so I like to put the sale dates in.
One of the properties as well. So I think you can edit the property and you can put some additional information or change it.
So I might pull up Zillow and in a different window, and I would make sure I put the sold date in, because if I'm really analyzing these accurately, I want to know the date that this sold, because that's very relevant. If this sold a year ago, the appraiser may not even use it. But if it sold last month, then the appraiser would put a lot of weight in it. And even if I had to appeal an appraisal, I could use this to send it in as an appeal and get some pretty good success.
On the rehab level, there's a drop down arrow on the rehab level. Jared's making some really good points that so you can see if you're looking at the photos going through it, is this a full rehab, no rehab, living condition?
Right, and so that's the other thing too, is click through the photos and you want to see if this property compares to yours, because it may be a partial rehab or it may be a no rehab, meaning that it could be in foreclosure status. And certainly you wouldn't want to think that your property wouldn't be worth a lot more if it's turnkey, if this is in foreclosure status and hasn't had any updates. So I always love to click through the photos. This one only has one photo, but a lot of times I'll even go into Zillow and I might even import more photos if I'm really serious about it. But I want to put the last date sold, I enter that. And then I also like to put the initial asking price, because if I have six comps and I can see the initial asking price might have been 150 and it sold for 136, that gives me an idea of how much of a seller's market it is or how much of a buyer's market. Or if the initial price was 120 and it ended up selling for 136, I know they may have had multiple offers that created a bidding war. And so I like to edit my comps and make sure I know the rehab level. Is it no rehab, or is it the same condition and it's a full rehab? Because then I'm comparing apples to apples.
And when you save this information in here, it's saved, so you can go back later and look and see how you came up with your price, your acquisition price, by looking at your comps and some of the data that you found on those comps. So we'll have to keep that information as well. Jared, Stephanie asked, I know we showed RPR previously, so if she's not a real estate agent, what tools does she have access to get?
I use Zillow, and then sometimes I'll also go to realtor.com, because with both of those different resources, they're very up to date, and I like how both of them give you the ability to map it. And when you can map it, you can see exactly where they are, exactly how close they are. And honestly, the MLS right now, I don't feel like it's that much of an advantage, because realtor.com and Zillow have all the information that the MLS has for the most part. They don't have the RPR tool. And sometimes there's a 4-hour or so delay sometimes before an MLS property will hit Zillow or realtor.com. It could be 2 hours, 3 hours. And so it gives you a little bit of an edge when you're competing in a tough market. But both of those resources can help you to get most of the information you need from a comp standpoint, as long as you understand the basic principles that Adam covered in tonight's webinar.
Yeah, absolutely, Jared. Those are very good points. And honestly, we created our own software because we couldn't find anything out there. We had to go to all these different sites to pull this information. And so in creating our own software, we can pull the different information into our site. So when we go in, and I think on a previous webinar, we showed, people how to screen, where basically we take a large list of properties and narrow it down to the very best deals. So that's pretty exciting. But Timmy, go back to the analysis, and let's just look at pull up a pro forma. Maybe we take our analysis and let's convert it over to a pro forma, create a report. And actually, let's grab a fix and flip pro forma, the buy and hold and the fix and flip. We're buying this for ourselves. Select whichever properties that you want, on there. Can you select up the 4 images? You can put whatever notes in there, whatever contact information if you need to share it with a partner or with a lender. And then
you guys, I would recommend getting this software. You can subscribe for a very cheap monthly fee. And part of the reason I like this is even if you're just getting the, pretty soon all Real Wealth Network vendors, I think pretty much will have this, and you'll be able to get these same pro formas from your Real Wealth Network vendor. But I like having these because potentially you could go find partners and take these pro formas to people and say, hey, how would you like to partner on this deal? I'll bring the team, I'll bring the deal, and we can, split profits and stuff like that. So if you've finished up your 10 loans and you can't get any more loans, maybe you put the down payment down and use somebody else's credit, and you're able to partner and go a lot further. But having these pro formas is good. And in a minute, we're going to show you how you can compare all of the different properties one against another to see which one's best.
All right, let's see what we got here. Okay, now we've got a good looking pro forma. It shows our cash. Now let's go look at some of these financials and compare this with what we talked about. You got financing, which here's your net cash flow per month. It's $430. If you're paying cash for the property, your cash flow is $829, but obviously your returns are going to be different. So we've got a couple different cards here, a buy and hold and a fix and flip. So as a buy and hold, if I'm analyzing this as a buy and hold to keep in my portfolio, it's going to have a gross yield is going to be 13% cap rate. It's going to be 9.26. Cash on cash is 18%. Anytime you have a high cap rate, you're going to be positive leverage because interest rates are so low. Got 32,000 equity. That's a big chunk of equity. And if you're flipping the property, again, you got a really high net ROI. I think we put 36 months as the holding time. You got 76 cents on the dollar. Your sale proceeds. Wow, our sale proceeds. We'll have to go in and look and see what we put as our sale price. Maybe pretty high. But again, all these numbers are just example. They're based upon whatever input you put in the property. When you're underwriting, whatever you put in there, that's what's going to determine what the output. And if you scroll down, we'll show you something interesting. When you scroll down, there's a chart and a graph, and it shows you the amount of debt, shows your debt being paid down, shows your equity going up, your appreciation, your cash accumulation. This is kind of a graph that illustrates your total return on your property, gives you some of some of those benefits. Other than taxes, we don't show that. We're not showing any after-tax calculations on here. Financing assumptions, your initial investment shows out-of-pocket as $28,000, and then your sale proceeds are going to be $52,000. There we go. And then we've got, from a cash flow standpoint, we got 1, 3, 5, and 10 years. Shows you all your cash flows, income, expenses, total expenses, and then it's below the line, which would be your financing cost. And it'll show you returns with and without financing. So there's a lot of detailed information on here. There's another pro forma that focuses a little bit more on cash flow. It'll show you the difference. It'll show your cap rate, your cash on cash, help you show the difference of those. This one's a little bit more for flips. So ultimately, this is how we underwrite our deals. We filter it, find the deal, and we start underwriting, checking comps, rent comps, sale comps, and verifying taxes, if it's got an HOA, things like that. We just get our underwriting done, we create pro formas, and we share them with whoever we need to share them with. So that's pretty much it. Jerry, was there anything else that you wanted to go into, or Timmy, did we miss anything on our slide? I think this is the Q&A portion of the.
You showed how it covers everything over 1 year, 3 year, 5, and everything like that. and gives you, what your profit would be and shows the appreciation and everything like that.
Yep. Annual, it shows your expense ratios at the top, and we can do another, we can do other webinars. So guys, and you guys are welcome to email us if there's something that you want to know. We have a whole series of these webinars put together that'll take someone from brand new in the real estate business to really having a strong understanding of a lot of concepts and principles in real estate. So
I love how this, and you may have already covered, I got a text from one of my contractors that I was looking at. I love how it shows the accumulated cash flow of what percentage of your equity is the cash flow that you've made, what percentage is the equity and appreciation. And I think that's very important, because when you're comparing properties, sometimes buying a B+ or an A- property, you may perform way better over a 10-year period, because it's a higher priced property, so it's appreciated, the percentage of appreciation ends up being more. And so when you scroll up just a little bit there, if you can, Timmy, so we can see, with this chart right here, being able to see these financial projections and see what percentage of your accumulated wealth was actual cash flow versus appreciation versus principal pay down by the tenant. That's a very helpful visual reference. I think the only thing I wanted to show more was when you go back to the software and you go to the grid view, how if you've selected maybe 4 properties that you've narrowed it down to, and let's say you're working with a turnkey provider in Houston, one in Atlanta, one in Cincinnati, and one in Cleveland, you can come over here to the
portfolio view. Pick on one of your portfolios. It's got more properties in it.
And so here we have a portfolio of properties. And of course, if you were selecting your portfolio and you were analyzing different properties in different markets, you could have your own portfolio, and it might have a mixture of properties from all across the country. But what we could do is, let's say we wanted to buy a property give me a price range and say, well, we want to buy something.
Click on the summary and the filter.
All right, so over here on this filter, I could say I want to buy a property between $100,000 and $130,000. And so I can say, I just want to analyze these between 100 and 130.
It's going to be property details, Timmy. Oh, that's your all-in cost, man. Your property details. There you go. I don't think we have any $130,000 in this portfolio, Jared.
What are some that we have the most of here? I see a 63.
We do have a few. There's 23. Sorry. Yeah, we do have one.
If we said between maybe 115 and 130, would that give us 8 or 9, 6 or 7?
Yeah, we got 8 properties right now. From 100 to 130, we got 8 properties.
All right, let's stick with that. So let's stick with 8 properties to 100 to 130, and let's just leave it there. I mean, I could filter further. I could say I wanted this many bedrooms and baths. I could say, okay, I only want to consider gross yields with a minimum of this, or cash on cash minimum of this. But I want to show you, even with no filtering, now that I have that, let's go up and click on grid view, which is these 3 lines at the dot. Yep, there we go. List view. All right, so now we're in list view, and what I can do is I can sort these very quickly. I could have checked out the pictures on the last view and said, let's eliminate this one and this one because they're ugly. But if I scroll over here, I want to say, okay, one thing that's real important to me is monthly cash flow. And so monthly cash flow is this column right here, and there's a little arrow. If you click on the top right next to it on the right of it, you can click on it. It says up. So I'm supported that this is least to greatest. So I'm going to click it again. So it's descending, and my best cash flow is $247 a month, and then $246 a month. So clearly, from a cash flow standpoint, these 2 properties are my best, and they're only 105 and 115 respectively, which puts them lower than the majority of the other asking prices. So I have more cash flow, but I also have a lower price on both of those. All right, so I like that. But then the next thing for me is equity. Do any of these have equity? So, because I want to get good cash flow, but I want equity. So if I sort that and go, and it already has it there. So we got 13,000. So that gives me a second option. This one's only cash flowing $162 a month. But if it has 6,000 more equity, I might consider that one as well. But I also want to look at the cash on cash return. So I would sort them a couple of different ways and say, okay, my best equity ones are these 3. The rest don't seem to have any equity, but Mabin, Marshall, and Forest Hills Drive, those 3 properties have equity. And then I can then from a cash on cash standpoint, I've got 12.5 and 11.4. So those 2 are really good. I don't really like the 6.3 on that one, but the equity is good. The cap rate's a little bit lower. So now I have to decide what's most important to me, cap rate or cash on cash return or cash flow. But clearly for me, as I look at all three of these, I'm already going to narrow it, and I'm going to put a check maybe by Marshall, and I'm going to put a check by Maben, and I'm going to say I think I want to keep both of those for sure. And then you might just scan down on the columns that are most important to you and see, are there any other cash flows that are in the 250, 247 range? And I might just scan down, or I might sort by monthly cash flow one more time. And it looks like those two are by far the best. And then so this very quickly allows me to take the emotion out and look at the numbers, and then I can go back to the view of the card view, and I can say, okay, Forest Hills and Marshall are the ones I think look the best numbers wise, and I can go back and look at the pictures, look and see which ones seem to make the most sense.
Now, Jared just basically quickly went through a large portfolio and narrowed it down to a few properties he actually wants to underwrite. And this is, again, we underwrite a lot of properties, hundreds of properties. So this is great speed for us. It's the main thing. And we're starting to run a little bit low on time. Jared, do you have any, Timmy, can you take us back over to our slide? There's one more thing I want to end with or mention. And so, okay, thank you. Ultimately, guys, so we put on here also, I think there's a link if you're interested in looking at the software, it's housefolios.com. And Jared's going to talk about, Jared's got a fantastic coaching program. If you're interested in looking at properties or interested in wanting to buy properties in any of these markets that we're in, and then there's a link right here for Doyle, and you'll see his calendar. You can actually go to your phone, and on your camera, on your phone, most smartphones, you have a smartphone, just hover your camera over the screen, and it'll pop up a link. You can click a link and schedule a call with Doyle to talk about specific, maybe you're interested in purchasing specific properties. If you want to do something maybe different, a little bit more outside the box, or you want to invest a larger amount of cash, you're welcome to schedule a call with me, and you want to talk about maybe something a little bit, you've got a situation maybe a little outside the box, or you want to have a discussion. I'd be glad to take a call with you. If you're interested in specific properties or getting information on specific properties, schedule a call with Doyle. And if you're interested in, you just want to get some coaching, you need somebody to help you kind of walk you through the process and help you out a little bit more, so you schedule a call with Jared, get some more information. I just wanted to make sure you guys had our contact information. We're here to help, want to help in whatever ways that we can. Jared, did you want to touch on anything else having to do with the coaching program?
I'll mention that there's over 52 videos. We spent $70,000 developing it. It's not a profit source for us. We just charged $499 flat. We wanted to make it to where everybody who wanted to really have help and get to the next level the fastest and invest with confidence, and have us helping you pick properties, helping you analyze properties, and getting into the best markets and understanding the sub-markets and the market timing and the market cycles and stuff like that. We wanted everybody to be able to get in at a price where it was really a no-brainer. We spend an hour a week with you in a group setting, going over everything, and there's a lot of case studies and homework assignments and podcasts and charts and a lot of useful things with 52 videos. So glad to have that there for you. If you want the help and you really want to get supercharged and get things done fast, that's a great way to get properties faster with better confidence.
Did anyone have any other questions or comments about anything that we've discussed? And you're also welcome to email us. Our emails are addresses are there, so reach out to us. We're going to keep putting out these educational videos and hopefully pass on some of the knowledge that we've accumulated being full-time in real estate for the last, I guess, couple decades. So, and we're really just doing what we love to do. And I call it living the dream, because that's what we're doing. I'm grateful to be able to do this, and look forward to hopefully helping some other people be able to accomplish their goals in real estate as well. So, we appreciate everyone's attendance, and those who weren't here, and we'll get this video emailed. You'll get it emailed as well if you want to refer to it. But we appreciate your time, and good luck in accomplishing your goals through real estate.